Welcome to RenMac Off Script, where we often discuss markets, economics, policy, history, and life. It is the 2nd of February, 2024. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
As a reminder and as a reference, we post most of the charts here on Twitter at our Twitter account, RenMac LLC, and our LinkedIn page. And if you like what you're hearing, go to RenMac Access. That's a site that we've created for retail and high net worth individuals to get some of the access that we send to our institutional accounts. That is renmacaccess.com. Well, we're going to talk about the polls. We're going to talk about payrolls because obviously that's important, the impact that the economy is having on said polls and the election outcome. And we'll give you an update on our market cycle clock from our world, some of the breakouts that we're seeing and breakdowns, and then importantly, what's obviously happening in yield. So let's get into it. It was payroll Friday, or it is payroll Friday. Big number, Neil. Odd number. I think there were some things that I have questions on between the work week and earnings, but what's your early assessment on the payroll number?
I think it was a fluky report. I think you're alluding to that. It was filled with oddities, but I think at the main story at the margin is that it reduces the sense of urgency for the Fed to ease policy. The economy is solid, and that's why they can take their time to recalibrate policy. I don't think it changes odds around May. There's plenty of months between now and then, but to the extent that there was any sort of hope around March, I mean, I think Powell more or less killed that anyway. But it suggests that he didn't make a mistake by doing that at the press conference this week.
Does he know that number? He doesn't know that number on Wednesday.
I don't believe so. I think the Fed gets parts of the data in advance to tabulate industrial production. But in my career, I've always put the most weight on employment day on the payroll number, and the payroll number was unbelievably strong. You had 353,000 non-farm payrolls. The prior 2 months were revised up by 126,000, and so the average over the last three is around 249,000, which is the fastest pace since November 2022. People were worried about the breadth of employment. That had been a sort of popular bearish talking point. Well, I mean, one of the arguments I've always made is that that number basically follows the pace of jobs growth. So if jobs growth picks up, shockingly, the diffusion index also picks up around it. But at any rate, it was at 65.6%. That was the highest since January of last year. Manufacturing was up. Temporary help employment, that rose for the first time in a long time. And retail trade rose as well, building on gains in December. There was some flukiness with the report, I must say. I mean, as an example, you had almost 600,000 people not at work with a job, but not at work due to bad weather. That was the worst January we've seen in a long time. I think since at least in the last 5 or 6 years. So it was a pretty, the weather did have an effect on things. And the work week fell quite substantially. Now, the work week is a more volatile kind of measure, but it was down a lot to 34.1% from 34.3%. I mean, that is a recessionary level for the work week. So we'll see what happens.
That's important, just to help people out here. That's important because the idea is that you'd work fewer hours before you lay people off, or you'd work more hours before you hire people. So
that's the theory, right? Is that it's basically hours lead bodies, but by that logic, why would you even be putting people on the payroll by the amount that you did? I mean, so clearly, I think one interpretation is that maybe firms are gearing up for growth, right? I mean, if you're saying that the work week should go down because employers demand less labor, then why would they be hiring, right? So in other words, the work week has been falling as payroll growth has been accelerating.
Right.
So I mean, it doesn't actually square.
Well, and importantly around that too, which you hit on, and I think that you got underestimated. That was the big number that shocked me, was the revision number, right? That was 200 plus for last month, correct?
Yeah, I mean, there's a theory that also has some momentum behind it, right? So there's pro-cyclical characteristics to revisions. Look, I mean, I think the number I like to look at is jobs, hours, and earnings. You put it all together, it rose 0.2. That's a bit cooler than it was, but it was, reasonably strong in the prior 2 months. And if you take a look at the last 3 months, aggregate weekly payrolls is up at just over 5% at an annual rate, which is fine. I mean, that's basically a proxy for nominal income, and so it's fine. To me, if you take all the data at face value, what it suggests is is basically a rapid pickup in productivity, right? I mean, the Atlanta Fed is tracking 4%. I mean, that number will come down after this report, but at the end of the day, the work week, I mean, aggregate hours worked are not rising nearly as rapidly as GDP. So that means implicitly output per hour is picking up, which means productivity is picking up, which means unit labor costs are low. So it's actually a reasonably good story for corporate profits. So it's kind of interesting to see, I mean, the markets are basically doing a knee-jerk thing where, rate expectations get pushed back and therefore stocks correct. But ultimately, this is good data for corporate earnings. And I think that's just worth pointing out, instead of this sort of mechanical thing that people do, with, rates up, stocks bad. Not necessarily the case.
And what are we tracking right now for the nowcast, the Atlanta Fed?
Well, the Atlanta Fed is over 4%. But as I say, I mean, the fact that the work week was down, that total hours were not strong in this report, that probably takes a little bit of the shine off of that number. But auto sales were also a bit softer. But as I say, I think January was a little bit of a fluky month. I mean, we did have some weather effects in the data. I mean, that is clear. But look, as you know, I'm not worried about the economy. I mean, the worst thing that happened for me this week is, I feel like I've always joked about how I felt like I was on a heater at a craps table with some of these calls, and now I think the March call, I think that's not going to happen. I mean, Powell basically put the kibosh on that, but I still think the Fed is cutting this year. I mean, he basically told you that. But I feel good that this is really just going to be a recalibration of policy. It's not going to be anything more than that because the data speak for themselves. The other notable
Clearly,
thing,
March would be a mistake if they cut in March. This is pushing
I
it
don't
back.
think it would be a mistake if they cut in March, because I think inflation's going to support them. And it's when you look at some of the data, like in terms of what's coming down the pipe and with respect to consumer prices, I mean, you could justify a recalibration of policy starting as soon as March. I don't think you should be cutting more than 3 or 4 times, but that would be the mistake. But I think the other notable thing this week was the ISM data. Manufacturing PMI, again, is sort of popular kind of bearish indicator, but the new orders component within that jumped over 50. And, you have more of the survey respondents telling you that their inventory levels are too low than too high, about twice as many purchasing managers telling you that they're too low than too high. That's going to support factory production in the months ahead. And it's not just in the US, but globally as well. I mean, I remember a time when people thought South Korea was like sort of the early sort of canary in the coal mine. I mean, well, guess what? The South Korean cycle's turning. Their PMIs are up, South Korean exports are up. And, I mean, that's probably going to set the table for how industrial production begins to look in some of the developed economies. So I'm not worried about the economy. I think people that are worried about the labor market, it's kind of interesting because historically people have said the labor markets are a lagging indicator. And I would just remind people that jobs don't really go into GDP. Jobs come out of GDP. One of the best things I remember was back in 2004 was during the campaign, and George Bush said something I think very interesting. He's like, jobs are created when the economy grows. The economy grows when people spend and businesses invest. In other words, if the economy is growing, employment follows. It's very unusual to have a period where you have jobless recoveries happen, but they don't last long. In other words, I would just say that there's probably room for hours work to pick up a bit between now and the next few months, because the economy is just it's growing well, over 3%. So unless you think labor productivity is like 3% on a trend basis, and I don't, I think some increase in total hours is inevitable at this point.
Yeah, I mean, the good news from the market's perspective is we're seeing, no real response out of some of the materials, particularly some of the material equities, some of the things that would be kind of this lingering indication that you've got an inflation problem, but they're also not breaking, right? I mean, if you had a break, then you'd worry about the economy and the implications of that from a global perspective, and that's just not happening. They're just in this nice kind of long consolidation trading range, which obviously in a trading range like this market is giving you weak relative performance, and that underperformance ends up historically being pretty important for equities. The interesting thing, Mr. Pavlik, is how does this translating for the polls? I mean, Biden's Achilles heel right now appears to be the economy, though if Neil's right, and this data would certainly be, on his side, the economy is going to continue to improve and look firm. That should start to help the underlying foundation for Biden, but that's not yet really reflecting itself in the polls. What's the disconnect there, do you think?
I may take issue with the Achilles heel being the economy more so than the cognitive ability, but some might see the two as interrelated. But you're right. Biden, in terms of his handling of the economy, polls right now aren't reflecting the same optimism that the economists are. You have seen some improvement there, and most of that has come from Democrats in terms of their response in terms of how Biden's handling the economy, which shouldn't be that surprising as we're now into an election year, sort of a rally around the candidate effect. The thing to watch are going to be the independents, and currently they're still more aligned with Republicans in expressing concern about the economy. Now, there is some disconnect and perhaps something more favorable to look at with respect to a Bloomberg poll that came out, in that people assigned negative opinions about the economy overall, but felt more optimistic about their own personal situation as well as that within their state. And so if that trend continues, if the economic optimism data sort of continues in the right direction, that's obviously good news for Biden. And there's also reasons to wonder and maybe why that Republicans and independents still aren't giving them the benefit of the doubt. And there are, I guess, two that sort of jump out to me. One, and this has been repeated, is that, voters have mostly experienced 20% increase with respect to inflation from the time Biden took office. And if you're sort of applying that standard as to what the economy was 4 years ago, January 2020, sort of right before COVID, if that's sort of their basis, then they're not happy. Even marginal gains over the past year aren't going to really matter that much to them. The other thing, and maybe more political, is just sort of if you blame Biden and the fiscal stimulus for causing a lot of that inflation, I don't know why you would give him much credit for now, trying to bring it down a little bit. I mean, do you really get credit for cleaning up a mess or preventing it from spreading as fast? I don't know. But again, I think just in a polarized environment, we're not going to see a lot of the shifts, just overall approval rating like we did in the past. The other thing to watch too is that the economy, while in terms of a top issue, is coming down among some voters in battleground states, more discouraging for Biden is that the immigration issue is rising. And that's obviously something that he has even worse approval rating on rather than the economy. And that's why I'm very skeptical that there's going to be legislation here to try to address it. So that's sort of the thing to watch, I think, moving forward.
Well, I mean, we did a quick on the the polls and the Real Clear Politics, and just looked at market performance when Trump's leading, market performance when Biden's leading, and it's pretty clear that the market performance is skewed towards Trump. Now, in full disclosure, that is a very simplistic operation. It's not statistically significant. It's economically significant, but we didn't allow for changes in short rates. We didn't allow for other variables to maybe be the explanatory variable
Trump
there.
throws it up
So
on Truth Social. We'll give him a discount on our research.
right. But the question is, if you're looking at this right here, and we've got, some of these trials coming up for Trump, how important are those going to end up being in terms of the polls? You might have support now, or it might be a close race, but if he starts getting convictions and has this, kind of sort of negative news cycle, not that he's ever had a positive news cycle, but if he starts having this negative news cycle, around these convictions, what are the implications for that?
Well, I think the thing to keep in mind is that not all the cases or convictions carry the same weight. And I thought that was sort of, I think, a little misleading in how the question has been asked in some of the polls, specifically the Bloomberg one. And I thought a better barometer here was actually one conducted by the Harvard Harris poll and Mark Penn, who was a former Clinton pollster, both Clintons actually. And he sort of looked at the different trials and potential convictions, and he found a 10-point swing if Trump is convicted in the January 6th trial, which is the one that Jack Smith is bringing, scheduled for March 4th. My guess is going to get delayed a little bit, but that's why you see a lot of the emphasis and focus on the media on that in particular. But Penn looked at, the issue of the document case. One, I don't think that case is going to be brought this year, just because you have a Trump-friendly judge there in Florida. You also are dealing with classified information. I just think it's going to be very difficult to have that done before the end of the year. But Penn found that most voters sort of consider it a wash, given that Biden also was found possessing classified documents. So did Hillary Clinton. The other thing that Penn found really didn't move the needle much was potential trial down there in Georgia. Obviously, we've seen a lot of news regarding the Democratic prosecutor there. She may actually be at more risk of RICO charges now than Trump, so have to keep an eye on that and whether that impacts the actual trial. But again, that January 6th case potentially has the ability to impact the direction of the polls. Now, keep in mind, one thing to factor in there is, Trump's obviously going to appeal the decision. So there's some question of social desirability bias. Are pollsters simply getting the answer to questions from respondents that the respondents think they want to hear? But that's going to be the thing, I think, between now and the election day that the Trump campaign is watching, because it's been successful for Trump in the Republican primary. People rallied around him. I don't know that a broader general electorate is going to feel that way.
And how about third party? There's some talk about RFK now with the Libertarian Party. Is that a bigger deal than,
Called it.
Neil did call that. He had the receipt, as the youngsters say, by forwarding me the email between a discussion the three of us had a few months back. So I'll give him credit for that. Yeah, that's a big deal, because the Libertarian Party has had success before in getting candidates on the ballots, all the ballots, including those battleground states. So if he's able to do that, then that could, alter the race. Interestingly, we're seeing a lot of the polls. He does pull from both Trump and Biden, and some polls a little more than the other. So that's going to be the thing to watch when you include Kennedy as well as Jill Stein, who the Green Party candidate who pulls exclusively from Biden, as well as Cornel West, Black professor activist, also pulls exclusively from Biden. That's when you see Trump's lead, and a lot of these polls actually expand if all three are on the ballot. And just that goes back to these polls. I mean, the pollsters have to make a lot of assumptions. I'm not defending them for getting a lot of things wrong, but they have to make assumptions about what that electorate's going to be, and also who are the nominees going to be on that ballot. So they have a difficult job, and you can see it from both ways. I mean, 2016, 2020, pollsters generally underrepresented Trump's support, particularly in those battleground states. Now, you could make the case, if you're Trump and the Republicans, that they're doing so again. They haven't corrected their methodology, and that the numbers are actually better than what the polls are saying right now. Conversely, if you're Biden and the Democrats, you might say, look, maybe the pollsters have overcorrected in making their assumptions about what that Republican turnout is going to look like, and maybe they're not as bad for Biden as they appear.
Well, I can tell you, I was at the Lions game, and it certainly, not this last week, but 2 weeks ago, at home, and it certainly, for Detroit, it was much more of it's called a red crowd than a blue crowd. And that's, we're talking about UAW workers, and we're talking about the kind of heart of what the political machinery is trying to get to. So
But
we'll see how that ends up
I,
playing out.
I just want to chime in terms of Michigan. That is where the Biden administration and the campaign right now is focused a lot, and it's sort of indicative of all these conflicting priorities in policies that you're having right now, because you have a very influential group of Arab Americans there that are not happy with Biden's position with respect to the Middle East. That could be influencing right now this response to the attacks that the Iranian proxies killed the three Americans, and sort of this signaling now for close to a week, what we're going to do and where we're going to do it to try to minimize the casualties there, which brings into question, maybe this is why this policy of deterrence isn't working. You have the labor element with some folks not necessarily thrilled about this transition to EVs. There could be some disconnect there between the workers there in the UAW and the leadership. And then you get into these LNG exports. Why maybe not necessarily a Michigan play. Look, if you're trying to win Pennsylvania and Ohio, and those two Senate candidates there from the Republican side challenging incumbent Democrats, that's not going to play well. Your Marcellus Shale region, taking away those jobs, I don't really see that as being something that you'd be that enthusiastic about. So,
Well, we'll see. Our market cycle clock updated this week, and we're in still a bullish zone. We tend to move to the right with growth improving and inflation staying relatively subdued. We did get a little uptick in the inflation as we've seen, but again, still in a very bullish zone for the equity markets. A little overdone on the sentiment side, not enough to make a call, but certainly one that could usher in a consolidation to kind of reset or pause these things. But again, we're still, I think, in the mode of the tails of the escape velocity that we had in the fourth quarter. So any consolidation should be well contained. 4,600 would be really kind of the worst case scenario for a correction slash consolidation here. And the only reason I even bring that up is because we're so far away from being oversold that if we were to get oversold, we'd probably have to go down close to that level. I think we're closer more to that 4,800 level, maybe a touch below it. And again, probably more through time than price to make this correction. Neil, what's on the docket next week for data?
There's not much. We'll get the ISM services number next week, but I think the main thing to watch will be the CPI revisions, which will be released on the 9th of February, so on Friday. That'll be the main event. And we'll see how they look. Last time we got big revisions, it kind of upended a lot of the story. I mean, Powell was talking about a disinflationary process, and then the revisions came out and kind of upended a lot of that narrative. So we'll see how it looks.
Does he lead it with his 60 Minutes interview this weekend?
Well, no, I mean, I think thanks for pointing that out. I mean, yes, Powell will be on 60 Minutes this weekend. And I think he's really using that to talk about two things. I mean, number one, basically that the economy is in a different place now than it was before, probably laying the groundwork for rate cuts as inflation slows. But I also think he wants to create space between the Fed and the election, which is coming up, later this year. Look, if the Fed wanted to help Biden, they would have started cutting in January. They didn't do it. Now, and obviously you have to ask, does the market believe in that? I mean, obviously probabilities around March are getting pushed off. We see what's happening with the rates market after the jobs numbers. So, look, I mean, I think that politics is something that people always talk about with respect to the Fed because they're in DC, but does that really enter their decision-making process? Certainly not nearly as much as the people claiming it do. And keep in mind that Fed policymakers have been going on 60 Minutes many times in recent memory. Bernanke was on there when he talked about, basically laying the groundwork for LSAPs and saying that inflation wouldn't really move because of that. He was right, by the way. Powell was on there in April of 2021 talking about the coming boom in the economy, that he wouldn't raise rates despite that. That also happened. So, look, I think it makes sense to cut rates this year. He's already told us that. The only issue right now is when they start. And if they're not going to do it in March, they'll do it in May. And that's sort of how I'm thinking about it. It's kind of, if you don't go in March, you might use March to set the May meeting as the start time.
I just remember Bernanke's appearance in whether it was 08, 09, I don't remember exactly, but I thought he was crying. The tenor of his voice was just like, it was very, very odd, but I think it's just his speech pattern. Steve Pavlik, what's happening in DC next week? I think Yellen's up on the Hill, right?
that's correct. To go to the House Senate for the FSOC hearing. I'd be curious just if Neil knew the history of Fed chairs appearing on TV in election years. I mean, he's going to get attacked regardless from whatever side feels he's not advancing their interests. But I do think that the timing's interesting. Outside of that, we have coincidentally on Groundhog Day that we're reporting this, that the Senate is still talking about unveiling the security supplemental And that gets into this whole border debate that we sort of touched on earlier. Look, I don't think that that's going to go anywhere in the House. The other thing to watch now in terms of legislation that did actually move in the House is this bipartisan tax bill. Senate Republicans sort of pouring some cold water on that right now. Whether that's just posturing remains to be seen. But the thing to watch there is going to be what changes they make. If they are just sort of cosmetic, that suggests that they're serious about moving it. If they're more serious, and they would likely come in at the work requirements portion that would upset the vote calculus in terms of Democrat support, then that seems like they're likely to kill it. Senate Republicans are actually using the argument against House Republicans on the immigration side, saying, why would we give a win to Biden? It just sort of reinforces the fact that legislative windows do close earlier in election years, and maybe even earlier than usual this year.
Well, we'll be watching the 10-year yield along with those support levels, and we still get these breakouts, which I think is important and useful in this kind of breadth of the market. We're seeing rails now, which obviously tends to be better for the economic data than not. But this contraction that we've seen, albeit not today, but the contraction that we've seen overall for the bond market, or in the bond market for 10-year yields, I think is important, with support down 375 and ultimately as low as 325, and resistance here at 420. Important because we were getting into a zone around that 420 mark that was starting to negatively impact our yield impact model. And so it was important that we saw some type of contraction in these long rates. And certainly we were moving towards that. The 50 days now through the 200-day, little knee-jerk reaction here around payrolls. Hopefully it is a one and done type of issue there, and we'll get back on the trajectory of stable to lower yields on the 10-year yield, which again should be more supportive for equities. Join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter and LinkedIn. And again, join us at RenMacAccess.com if you want some insight into how we're thinking about the world. Until then, I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
We'll see you.